as blunt as it was, it's something that South Africans might still not be able to put behind them, as we are expecting some more pain to come with the petrol price increases next week that are expected, as well as possibly more interest rate hikes in the next couple of meetings, with the next one in May. We're now joined by Economist at Momentum Investment, Sanisha Packirisamy, to react to the latest interest rates decision. They've also released a report themselves, which is based on consumer pulse and how consumers feel at this present moment. We're going to get into that a bit later. Sanisha, thank you very much for your time. Was it expected from your side that it would be 50 basis points? The market expected a 25 basis point hike. How do you view the change that is out of kilter with the expectations?
Good afternoon, and thank you for having me on the show. No, so we did not anticipate the 50 basis point increase, and I suspect that consumers from our report are probably going to feel a lot worse after this 50 basis point increase, especially those that have a mortgage or a car loan outstanding. If we look at the Reuters consensus going into this interest rate decision meeting, about 18 of the 20 analysts, the majority of the analysts out there, were looking for an increase of 25 basis points, and the remaining two were actually looking for an unchanged stance in interest rates. So the 50 basis point increase definitely came as a surprise to financial markets today.
Yeah, many people were taking educated guesses, as we heard from the Reserve Bank governor. Another worrying look is what he announced when it comes to inflation, but not only inflation, but the outlook itself, saying that we expected that South Africa to now be able to garner a GDP growth of 0.2% in 2023. Let's take a listen to what he said earlier on.
The domestic and global outlook appears to be highly sensitive to new shocks. Core inflation remains high in much of the world, and financial vulnerabilities have re-emerged to create new headwinds. Turning to inflation prospects, our current growth forecast leaves the output gap around zero, implying little positive or negative pressures on inflation from expected growth.
Sanisha, a lot of people are still going to be garnering for the MPC, to criticize the MPC, to say they are quite blunt in the way that they are trying to deal with inflation. What do you make of how the Reserve Bank has actually performed in making sure that we keep a tame inflation, most importantly, and by using the monetary tightening policies as a blunt instrument?
I think it's important to note the transmission mechanism of monetary policy. And when you raise interest rates, it really hurts your upper end consumer, because these are the consumers that have prime-linked mortgages or vehicle loans that are outstanding. However, for the ordinary man on the street who's facing inflation, food inflation of north of 12%, your lower income earners facing inflation closer to 10%, that's really the bottom 30% of spenders in South Africa facing inflation of around 10% rather than what we're seeing on a headline level. We would like to see interest rates trying to rein in demand in order to start softening inflationary pressures. And this is really what the Reserve Bank is seeking, to try and rein in those inflation expectations and to really protect your lower end consumer from the cost of living crisis that is currently spiraling in South Africa, but also around the world.
Sanisha, sluggish growth, logistic problems here at home, and load shedding, another own goal of ours, were topical. Load shedding being a topical issue, and bringing down those forecasts for economic growth from 0.3% in 2023 to 0.2%. What do you make of that? Because load shedding is still going to be with us for some time.
Well, when the Reserve Bank announced their move to GDP to 0.3% for this year, that was in the January MPC meeting, markets were already quite shocked at the extent of how weak that growth number looked. However, we've seen the Reuters consensus that takes into account the economist's forecast out there has actually migrated lower over the course of the last month, and the consensus view is that growth will be 0.4% for this year. Our own internal assumption is somewhere between the two of 0.3%, again on the back of the supply-driven constraints around the transport sector, but more importantly around the electricity sector. We've seen that the SARB has done some calculations around load shedding's impact on growth, and they've maintained these forecasts to suggest that the load shedding will probably shave off about 2% of growth this year. So in other words, growth in South Africa could have probably been around 2% higher if it were not for the intensity and severity of power outages that we are currently experiencing. Of course, we know that load shedding has quite a negative bearing on consumer spending as well as private fixed investment. And to some extent even our exports, given that we would then have less production of certain minerals and exported manufactured goods going to our ports.
Let's talk about the report that you have released as Momentum Investments, the report titled Consumer Pulse, basically on how consumers actually feel at this present moment. And it shows weak sentiment across all income groups. And it's something that we've seen with other reports as well, whether it's homeowners report, whether it's consumer confidence index. This particular report is no different when it comes to what it has found in terms of the current state of how consumers are feeling at this present moment.
Definitely. So across the board, we're seeing, suppressed sentiment. And it's not really only on the consumer level, we're also seeing very suppressed business sentiment. Again, I think load shedding is playing quite a significant factor across the board. For consumers, we've also seen that high inflation outcomes has eroded real wage gains. In other words, taking away from the money that's available in consumers' pockets at the end of every month. And so we are starting to see signs of consumer stress coming through, with consumers looking for bargains at the end of the month, doing bigger shopping rather than smaller shopping during the month so that they can limit impulse purchases and limit discretionary spending. We're seeing much of a move towards your necessity spending and even some down trading, just highlighting the pressures that the South African consumer is coming under. And even though the employment numbers did tick up in the latest quarterly employment survey, we are still seeing widespread unemployment on an expanded definition of unemployment, which includes those workers who've just given up looking for a job. We've seen that unemployment rates are actually closer to 45-46%, suggesting some weakness in the labor market in South Africa.
The report talks about looks at a number of different indices, and when it comes to economic data as well, it shows that high-income earners are quite pessimistic, while there's a lot of optimism when it comes to low and middle income earners. What can you tell us about the expectations when it comes to household finances in the year 2023?
So I'll say that this is a little bit of a conundrum, because your lower end consumer is facing much higher rates of inflation. We've seen real wage growth being negatively declining over the last couple of months because of higher food inflation and transport inflation. Even though we have seen social grants increasing at the same pace of inflation, we haven't actually seen any real increases coming about. And on the employment side of things, your unskilled workers and semi-skilled workers, in terms of the number of jobs, is still below pre-pandemic levels. In your middle and upper end consumers, we're starting to see that inflation is a little bit lower than what you're experiencing at the lower end, simply because food makes up a smaller portion of their baskets. And we have seen much bigger job gains coming through, particularly for your skilled workforce. And I think that's really due to things like immigration taking place and reducing the supply of workers in the South African economy to match to the demand for those skilled jobs. So going forward, we're actually anticipating that your higher income earners are going to drive consumption spending in South Africa, despite the fact that the results of the consumer sentiment surveys are showing a slightly higher level of confidence or slightly less negative level of confidence for your lower end consumer. I think if you look across the board and make some broad brush statements about the consumer sentiment levels, we've seen that the typical higher income white population group in South Africa tended to be a little bit more negative about the economic prospects a year from now relative to the lower income and black population groups. And we're also seeing quite a significant divergence between the expectations on the economy and the expectations on finances. So in general, the average consumer is a little bit more upbeat about the expectations on their own finances, but much more downbeat about economic prospects. And we have actually seen that big gap opening post-pandemic. So I think trends here have also shifted in terms of expectations on the economy relative to their own finances.
And before I let you go, Sanisha, something that is quite startling is the expectation that food price inflation in 2024 is going to be at 9.9%. What does that mean for consumers? And going into 2023 ahead of that 2024 expectation?
So with food inflation, averaging close to 10% for this year, it does mean that your lower end consumer is going to be disproportionately hit. Your lowest 30% of spenders in the economy have their food inflation accounting for about 40% of their overall basket spending.
Sanisha Packirisamy is the economist with Momentum Investments. Thank you very much for your time talking to us about the latest Monetary Policy Committee decision increasing interest rates, raising interest rates by 50 basis points. And of course, their latest Consumer Pulse report showing that across all indices, it is quite a difficult space to be in, whether in business or in the household in South Africa.